In this video, we'll be discussing about Warren Buffett's journey, how he became a very successful investor over the period of time, and what are the key learnings out of his investment career that we'll be discussing in this video. So, if we check, the Warren Buffett started at the age of 13 when he was a very small kid, and Warren Buffett used to sell the groceries from his shop of his grandfather, and from that point of time his journey started. So he used to go to door for selling the chewing gum, or he used to distribute the newspapers, or then he used to collect the different caps of the different cold drink bottles. And that is how I think he got introduced to Coke, and over the period of time he has created a massive wealth by investing in Coke and different companies. So again, today Varun is with us, and we'll be discussing about the various companies the Warren Buffett has invested. What are the basically his criterias or main framework which has helped him to understand more about the businesses and how he has created a massive wealth over the period of time. So we'll be starting firstly with basically which type of companies which one should buy, because if we check the early career of the Warren Buffett, then basically he has started with the cigar butt approach, that he was not focused more on a quality of a business, because probably he learned that the valuation is very important thing from the Ben Graham. And over the period of time when he actually got introduced with the Charlie Munger, when he joined the Berkshire Hathaway, then both of them I think thought through, and they understood that rather than statistical cheapness of a particular company, one should focus more on a quality of a business. So Varun, what are your thoughts on a quality of a business? What actually an investor should look to determine the particular quality of a business? And then later we, when we'll discuss about margin of safety, we'll touch the point on evaluations.
So a high quality company can be of two types. It can be one company which has a huge opportunity size, and they have enough runway to keep investing their cash flows to grow. And there is another type of business which also has a huge opportunity size, but they don't require reinvestment to keep growing. So Warren Buffett generally looks for the second type of companies which generate massive amounts of cash flow, and they don't need to reinvest that cash flow into the business to keep growing their business.
So Warren Buffett tells in many of his basically letters that a person can actually take the dividends from certain companies and then invest those dividends in some other companies where there can be a good growth or good valuation. So that is the one criteria which the investors might look. But I think the really important thing what one should understand is there are one type of companies where the high amount of capital is not needed, or every year you don't need an incremental investment just to sustain in that particular business. For example, in India, the companies like IEX or CDSL. So these companies absolutely don't need any capital to run that business. These companies keep on throwing a lot of cash every year, and then the problem with these companies is that they cannot reinvest that cash. And we have to differentiate between us as a retail investors compared to Warren Buffett. Warren Buffett generally used to buy whole companies. In this video, we'll also discuss about the Seas Candies, where the Warren Buffett has completely owned that company 100%, which is not the case with retail investors. So that is one type of a business or one type of a framework for the investing, which is very, very solid framework. But apart from that, one should also look for which companies which actually can take that capital which a company is generating in a particular year and redeploy that capital at very high rate, so that the business also keeps on growing over the period of time. So let's discuss about some of the examples. So Varun, in the case of say Laurus Labs, so if you check, that company doesn't use a very high amount of dividend if you compare that with say IEX or CDSL or probably Coke or some other companies.
Yeah.
So where the company is trying to take that internal cash flows and redeploying it probably at a better rate or the better businesses. So what is your understanding about the Laurus Labs, how they have done this over the period of time?
So if you look at the returns that Laurus Labs has generated with its business over the past few years, if they were to give the cash that they generated from the business to you as dividend, you as an investor would have to look for opportunities to invest that cash that would generate a higher rate of return than Laurus Labs can by investing it back into its own business. I don't think there are a lot of ways where the retail investors can find, opportunities to invest cash flows like that. It is better that those cash flows stays inside the company and the management uses that those cash flows to actually grow the business, because in the pharma industry the opportunity size is very large compared to the size at which Laurus Labs is today. Like the largest pharma company in India, Sun Pharma, is about a 2 lakh crore market cap company, whereas Laurus Labs is a 20,000 crore market cap company. So the opportunity size for Laurus Labs is very large. So it is better that they keep investing that cash flows into their business to grow the business.
Right. So first point here is that basically we have to really find out a very high quality business, and in terms of like high quality, which means like the business should at least able to redeploy that capital at current with whatever like returns they are getting, or the best case scenario is if they can get the better returns by investing the incremental capital. And the examples could be Laurus Lab is doing very good in that nature. Let's keep the share price away. Second example could be probably Deepak Nitrite is also a similar case study where they have like started various divisions like phenol, acetone, and then now they are going the downstream where their capital redeployment is probably increasing over the period of time, or if you can take like last 10 years horizon. And these are the fantastic businesses provided that you buy them at a right valuation. We're going to come up with the valuation point as we go ahead in this video. And I think Varun's second very important point is that like along with the business, the management has to be a very competent, and that job is actually a management job, how to redeploy that capital, because we as a shareholders, as a minority shareholders, we don't have any say where the company can redeploy that capital, or can the company can like give higher amount of dividend, or they will use that cash internally. So like the having a high quality business along with the high quality management actually pays off end of the day. So what is your understanding and how can we relate that point with the Warren Buffett, which companies he probably invested historically? What is your understanding on a management side?
So for Warren Buffett's investing approach, like having a very high quality manager for the businesses that he picks is extremely important. Like if you look at all of his interviews, like the way he talks about, the then CEO of Coke or the CEO of Apple, Tim Cook, he says that Tim Cook is probably the smartest guy he knows.
Right.
Like the way he understands the world, there aren't a lot of people in the world who understand human behavior as good as Tim Cook does. So even like the other businesses that we are going to talk about now, like businesses where Warren Buffett acquired, like 100% of the company. The first thing that he did was put a very competent manager in place. So because once a competent manager is running a business, Warren Buffett doesn't have to worry about where to deploy the cash flows of the business in the future. The manager finds the most profitable ways to deploy the cash flows that the business is generating, and he invests accordingly. That headache is taken off of like Buffett's plate.
Correct. So I think I would probably go with the second approach. I mean, like what we were discussing about the quality of business, like either the business have the redeployment power in itself, and the second case is basically it is just giving me the dividend. Because so out of these basically two approaches which we are discussing about the having two type of businesses, wherein first type the business keeps giving the dividend and the investor have to keep on finding out better and better ideas to deploy that cash, or in a second basically approach where the management is competent to basically redeploy that cash back into the business at very very high rate. So I will prefer the second type of opportunity where I don't have to actively do various things. So let's discuss this point with one of the case studies of the Seas Candies, like the how Warren Buffett identified Seas Candies as an investment, and then over the period of time, like people just look at their business, but we have to understand what kind of a cash flows Warren Buffett got over the period of time, and how he redeployed those cash flows back into some other businesses where actually he has created a massive wealth over the period of time. So Varun, like how he identified and like what were the valuations at that point of time, and then like definitely it is a like 100% stake he has taken rather than like buying it from the stock market.
So Seas Candies is a chocolate making company. So this was a company that was started by Mary C. It was her homemade candies that her son Charles C. used to sell in their stores, right? And Seas Candies was the first time that Buffett and Munger actually used quality as an additional factor to evaluate a business rather than just book value. Like up until now, Warren Buffett was actually just following Graham's approach, where he was trying to buy companies that were, like cheap on paper.
Correct.
Like he would try to buy stocks at like 0.2 times, 0.25 times, 0.5 times of their book value, and he would sell them when they reached their intrinsic value, their book value. And The first time that they actually deviated from this approach was See's Candies. So See's Candies is a business that sells chocolate. So because it is a chocolate making company, they sell these chocolates for cash and they receive cash for it immediately.
Right.
The chocolate is a perishable good. So the inventory that they hold is also very small. And the amount of capital needed to manufacture these chocolates are also not a lot. So what happens is that the business has very little cash needs and it throws out a lot of cash. So he paid about $25 million for this business. At the time, it had $30 million in revenue
Right.
and about $5 million in pre-tax earnings. So if we assume a 30% tax rate, then he bought the business at about 7 times P.
Price to 7 times price to earning and about probably little bit more than 1 times price to sales.
Yes.
And then actually the interesting part is like this business never needed any external cash from Warren Buffett or like any other investor, while it kept on throwing a lot of cash for the Warren Buffett, which he deployed in some other businesses. And like let's discuss about the pricing power of this business with reference to the gifting approach, because that is the uniqueness of this business. It's not only a chocolate manufacturer.
Right. So what Warren Buffett and Charlie Munger understood about this business is that people don't buy See's Candies for their personal consumption.
Right.
They buy it as a gift. They buy it as a gift on Valentine's Day. They buy it as a gift on Thanksgiving, or they buy it as a gift on Christmas. So what happens is that people don't go for the cheaper product when they go to buy a gift. They always go for a high quality product. And See's Candies was always considered a high quality product. It was a well-known product in the area that it operated in. It was never a pan-US company.
Right.
It only operated in the western region of US, but it had very strong brand recall. And this brand recall is what gives them pricing power, that anytime there is an increase in the cost of their raw materials, they can pass it on to customers, because the customers are going to buy it at whatever price they get it, because it is a gift that they're buying for someone. If you're going to buy a gift for your wife or your girlfriend for Valentine's Day,
Right.
You're not going to go for the cheap box of chocolates. You're going to go for the high quality box of chocolates that she knows and she loves.
Right. And that is how, if you check in this business, actually the volume growth has not happened at very high CAGR. Probably the total profits, which has grown by around 10%, which is majorly happened due to the pricing power which they have at, or the Warren Buffett used to tell that like they used to increase the prices every 26th of December, just after the Christmas. So that actually shows what kind of a pricing power the business have.
Right. And the beautiful thing about this business is that there are no capital needs. So this massive amounts of cash that See's Candies is actually generating does not need to go back into the business for the business to grow. Right. So they paid $25 million for this business, and today the business does about $380 million in revenue. So
Right.
cumulatively since 1972, when they acquired 100% of the company, Warren Buffett has actually received over $2.2 billion in dividends from this business, which they have used to acquire other businesses.
Right, and which probably have actually given them the growth from which they have accumulated a large amount of wealth over the period of time.
Right.
So this was the point related to the good business, basically managed by the great management or the good management, and then about which approach you have to choose, like having basically a business which throws lot of cash at the end of the year in a form of dividends or in a form of buyback, or a second type of a business where the management is efficient, which actually knows how to redeploy the cash back into the business. I will prefer the second type of management or second type of business. Now let's understand more about the circle of competence. So circle of competence means basically do only those things which you understand, because that is very, very simple, but that is very, very strong framework. What Warren Buffett says as a rule number 1 and rule number 2. So he says that never lose money with the rule number 1. And with rule number 2, he says like don't forget the rule number 1 ever. So if we correlate with the circle of competence, then he used to give the example of Ted Williams, who was a very famous baseball player, and he used to correlate with the strikes. So as we play basically a baseball, if you have at the max 3 strikes, the player is out and he has to go back to the pavilion. But what he says is basically there are no called strikes in an investment. So you keep on getting a lot of opportunities you have to like sit like a snake, and you have to watch for your basically rat when it comes, and you have to just grab that opportunity. So how can you correlate Varun with this approach, and like how should one and then definitely we'll also understand about different case studies over the period of time where the Warren Buffett has used this mental model, and which has actually helped him to create a wealth over the period of
So the basic thing about circle of competence is that you have to be in a position where you have an advantage over everybody else. So suppose if you are a person who works in the IT industry, you have an insight into what is going on into the IT industry better than someone who works in banking. You have an informational advantage there, that what are companies doing and which way the industry is moving currently, that someone who works in, maybe insurance or some other field like manufacturing might not have. Someone who works in banking understands that space way better than someone who works in IT. So he has an informational advantage about what banks are currently doing, which direction they are moving in now. So he can look for banking companies, and the IT industry professional can look for IT industry companies. So this puts them in a position where they have an informational advantage over the rest of the market, and they are best placed to actually gain from whatever the new changes that are going to be happening in the industry, because you are on the ground and you know it better than anyone else. So that is something that we should practice in our lives. Like, we should try to stay away from businesses that we have an information disadvantage over someone else, and try to be more in businesses where we have an informational advantage.
right. And another point here is basically like one as an individual or even with the team cannot track all the businesses or all the sectors. It is always basically a arbitrage between the time and what kind of value or where you can actually find a real great opportunities. So you have to have a very narrow focus on certain stocks or certain industries where you actually have an advantage of understanding that business in very in depth, and then actually you have to bet big, which will basically come to this point about the allocation later in this video. So let's first understand about like the example with the Geico, where actually he over the period of time developed his circle of competence to understand the insurance businesses. And actually if we have to take the timeline also, because it is not like that he understood the insurance business on the day one, or he bought the full company as a Geico on a day one. It is actually his journey. So let's now discuss about like what has been his approach with the insurance business, and then how he has basically used his understanding to buy the complete business of the Geico later on.
So Warren Buffett says that, like, I am not a genius. I am smart in spots, and I stay around those spots. So Warren Buffett's circle of competence is majorly into insurance, into banking, and into consumer products. With the insurance business, the way he has built this circle of competence is a very interesting story. So back when Warren Buffett was 21 and he was studying in Columbia University under Benjamin Graham, Benjamin Graham was one of the largest shareholders of Geico, and he was also on the board of Geico. So Geico is an insurance business. It's the full form of Geico is Government Employees Insurance Company. Through statistics, they found that government employees are the least likely to have accidents. They are the safest drivers on the road. Right. So Geico as an insurance company said that we are only going to sell insurance to government employees. And that is where the name comes from. Government Employees Insurance Company. So, and the other thing that Geico did was they were selling their insurance directly to the end customer without having any middlemen. Right. So their expenses were also low. So this was actually the moat that Geico had. They had like lower costs than their competitors, and they were only insuring the safest drivers out there, so they had the least amount of claims. So this was a moat that the market was not recognizing at the time, right? Because Geico was trading at a valuation much lower than its other listed peers. So Warren Buffett actually spent the time to understand. At the time, he had no understanding of the insurance industry. But what he did was, one day he left college and he went to Washington DC, where the headquarters of Geico was, and he sat with an executive back then who later turned out to become the CEO of the company. And he spent about 4 to 5 hours with him and completely understood what the insurance business actually is and how it functions. And when he came back, he put over 50% of his net worth into Geico.
Right.
So this was in 1951. So Warren Buffett was 21 years at the time. He invested $10,282 of his personal money into Geico. And then a year after that, he sold it for about a 50% profit. So in 1951, he exited the company and then he re-entered the company back in 1976. So this is where, you build a circle of competence where even we realize certain businesses that, we have exited and then we have re-entered them.
Right.
We are better poised to actually understand that business because, we've been tracking it for a very long time.
Right.
And our understanding of the business has evolved over time.
Correct.
So in 1976, when Geico was kind of bankrupt, Warren Buffett entered the business again and he helped turn around the business where he helped them hire a new CEO. At that point, he bought about $4.1 million of common stock and about $19.4 million of preferred stock. And from 1976 to 1980, he had invested about $45 to $46 million of his partnership in Geico. So that stake was valued at $2.4 billion by 1995. During this time, Geico was also doing a lot of share repurchases.
Right.
So what had happened was that those share repurchases, they took Warren Buffett's stake in the company to over 51%. And that 51% was worth $2.4 billion. And at that time, he spent about $2.3 billion to acquire the remaining 49% of the company and made it a wholly owned subsidiary of Berkshire Hathaway. In total, he has spent about $2.3 billion acquiring Geico. Now, in 2021, Geico had about $37 billion in revenue and $1.2 billion in pre-tax income.
So here, if you notice, there is some pattern. First thing is like he initially, when he was a kid or he was learning about the investment, he used to take some stake and then he used to churn like in a probably 1 or 2 years. It is like a pattern with other companies also, which we'll discuss. So initially he used to bet like probably a smaller amount. It might be a very high percentage for because his overall portfolio was a very limited portfolio. And then if you check the pattern, that massive amount of wealth or maximum amount of wealth of Warren Buffett has created probably maybe less than 10 companies. And those 10 companies which he invested like Geico or Coke or American Express, he kept on buying those companies at different intervals when he had a better and better understanding. Like same is the case with Geico. Initially he bought like when he was a kid, and then later on like he ended up buying a whole company under the Berkshire Hathaway as a company. The same thing has happened with the Coke also. So Coke, like as early as if you can check, then he used to collect those bottle caps where he understood that the Coke basically drinks are very famous and that's why he used to get those bottle caps. So Warren Buffett at very early stage understood that the Coke as a brand is a very well recognized brand, and then he ended up creating a very large position probably in 95 and before that about 85 and those time. So let's understand this approach with another case study of Coke, like how Warren Buffett actually able to find out the Coke and how See's Candies and Coke actually as a investments are interlinked with each other. So Varun, can you describe about his Coke basically investment and what was the framework which Warren Buffett has understood or able to implement?
So the reason why Warren Buffett ended up investing in Coke was because he bought See's Candies in 1972. Like he has said that when they actually bought 100% of the business, then they were in charge of running the business. They were in charge of, looking after inventory and how many stores to put and how to grow the business,
Right.
which actually taught them a lot about consumer behavior.
Right.
So what Warren Buffett says is that they might have only made those $2 billion in dividends from See's Candies, but even the $12 billion or whatever amount they have made from Coke is also attributed to See's Candies.
Right. And if you check the time frame also, I think See's Candies they bought in 1972 and
Right.
probably Coke they bought in 1985 or 87. So they had about like 12 to 13, 14 years of time period where actually they were like running the See's Candies as a business, and which like taught them how to basically what is the strength of a consumer business where the brand power is created by a company where they have the pricing power. They can able to successfully pass on the prices to the consumers. So these things actually comes by running the actual business. So what Warren Buffett says is like I'm a good investor because I'm a basically good businessman, and vice versa. I'm a good businessman because I'm a good investor. So these things actually I think he learned from the his Seas Candies as a successful investment. So let's continue with the Coke story, like what actually has happened during that period of time.
Right. So his understanding of Coke was actually starting to build when he was, 13 years old, and he was collecting those bottle caps, and he could see in those bottle caps that most of the bottle caps were Coca-Cola bottle caps.
Right.
So he understood very early that Coca-Cola was the best selling drink in the United States, and that was the drink that he used to buy from his grandfather's grocery store and sell to his classmates and in his neighborhood.
Right.
And whatever money he used to get from that, he used to invest in shares.
Right.
So he has been building his understanding of Coca-Cola since he was a very small child. And one thing that he understood was that isn't going to be a competitor other than Pepsi who's going to come into this market and take away market share from Coke. What Coke ends up doing is that whenever there is a new trend in the beverage market, they end up acquiring that company. Like we can see over the years that the sales of their main product, which is the cola, has actually reduced, but they have kept acquiring brands like bottled water, or if you see today, like there is a trend for sports drinks and coffees and uh, energy drinks or green tea, and Coke has acquired brands in each of these segments, and then they use their marketing machine and their distribution network to grow these brands. So this is a business that is not very capital intensive because the manufacturing for this is completely done by the bottlers. Coke only manufactures the main syrup, which is then sold to the bottlers or the restaurant chains, and the rest of the capex has to be done by the bottlers. So Coke is actually a very asset light model. They do not require a lot of assets to manufacture the syrup. It requires very minimal investment.
So I think the strength of the Coke is like their asset light model, where they spend maximum amount of time and energy and probably the money in marketing of the product rather than spending that amount into manufacturing that particular product.
Right.
And then we can see like how the Warren Buffett has able to scale up his investments over the period of time. And right now it is one of the largest position for the Warren Buffett in his today's portfolio. So it was the second basically consumer faced company after the Seas Candies, where he has created a huge amount of wealth. So let's understand a bit more about the Coke, and then we'll also discuss about like the Coke. Is it a good investment today if anyone wants to invest in Coke? Like, because everything we cannot copy from the Warren Buffett. We have to tweak the things according to today's world and according to whatever capital we have. Because one of the most important advantages which we have is like we have the very tiny capital. And as and when your capital actually increases, that also becomes a very difficult path or where you can maintain your CAGR over the period of time. And if you check in this graph, the like basically Warren Buffett CAGR have reduced over the period of time, or if you can check his last 10-year returns are much lesser compared to when he actually started. And the key reason for that is net worth, or his basically the investments or the cash pool has increased over the period of time, which was very, very small when he was starting. So let's come back to the Coke story. Like, Varun, what has happened after that, or like what are the other points which you can share with our viewers?
So Coke is obviously not a business that like Warren Buffett identified very early on. It was a 100-year-old company at the time when he invested it.
Right.
And Coke was one of those rare companies which has not only paid a dividend for the past 60 years, but they have always increased their annual dividends every year for the past 60 years.
Correct.
Right. So Coke is generating massive amounts of FCF, and what they're doing is they're paying dividends and they're buying back shares. So Warren Buffett has not sold a single share of his Coca-Cola holding, and Coke keeps doing these massive buybacks each year. So what ends up happening is his stake in the company keeps on increasing. The first time where Warren Buffett was able to replicate what he did with Seas Candies at a much larger scale, where he changed his investment approach from buying bad companies at deep discounts to buying like very good companies at reasonable prices.
Right. And I think that thought process is introduced by the Mr. Munger. Like may not be that famous compared to Warren Buffett, but his mental models and his approach actually change the thinking process of the Warren Buffett, and that actually immensely helped the total Berkshire Hathaway's investment approach and the total wealth which they can create for their shareholders.
Right. And even like Charlie Munger's like understanding of like consumer businesses is what helps Berkshire Hathaway identify these kinds of businesses. So if we look at like Coca-Cola today, would it be a good investment for someone like us? The answer is probably no, right?
Right.
Because like Warren Buffett needs that kind of an opportunity size where like he has this massive amount of capital which he can invest in a business and hold it forever, where he doesn't have to exit, because exiting that business would be a problem for him. So he needs a business which is actually, he needs a very high quality business which he can buy and hold it forever.
And
Whereas,
plus, he also needs like a larger business. So he is basically in the race of shooting the elephants. We are like probably finding out the rabbits who can jump and create like a massive wealth in a short period of time, because our portfolios are very, very small. When we'll have the larger and bigger portfolios, we'll also probably go in a elephant shooting race or something. So like coming back to the point of a consumer understanding of the Warren Buffett. So once first he started with the Seas candies, then then he replicated that with the Coke at much larger basically opportunity size, and the biggest is probably the Apple. So let's discuss about the Apple case study, and like where his current portfolio is probably more than $150 million or more than that, and out of that about 40% investment is sitting in the Apple. And this Apple is nothing but the consumer story rather than the tech investment, which Varun will basically explain like how he identified it and what were the different points which actually coincided with the Seas candies or the Coke investment, which he has done priorly probably 20-30 years back.
right. So if we look at his investment in Apple, if on first thought you would think that it does not fall into his circle of competence, and Warren Buffett has famously said that he does not invest in tech companies because they lie out of his circle of competence and they are very prone to disruption. Like he has been best friends with Bill Gates for a
Right.
very long time and he
Right.
never
Never
invested in
invested in
Microsoft.
Right.
But the reason he invested in Apple was not because it's a tech business, it was because it was a consumer business.
Right.
And he actually had to be convinced by his managers, his fund managers, to actually invest into Apple. Like the story goes this way that, one of his friends who lost his iPhone in a taxi actually came and told one of Warren Buffett's friends that, when I lost my iPhone, I felt like I lost a piece of myself.
Right.
And this is something that Warren Buffett's friend told him. And Warren Buffett, was seeing that, how obsessed his grandchildren were also with this product. So he understood that Apple was a business that was very essential to people's lives.
Right.
So he has called it the modern day Kraft Heinz of today,
Right.
like.
Right. And if we connect the dots between the Seas candies, then the Coke and the Apple. So Seas candy we started with like that. It is a gifting basically product, not like the consumer is buying for themselves.
Right.
So there is a definitely some emotion which is attached to it.
Right.
Second thing is again the Coke, because like people feel something good about themselves or after having a Coke. And third thing with the Apple, again as you told about the story, so always there is some emotional connect with the product which is actually helping or turning it to the consumer product and not basically a technological based investments with the Apple. So let's continue with the Apple one.
Right. So Warren Buffett has called Apple the best business in the world. So Apple is today like the most profitable business in the world. It has about 20 to 25% net margins, and we can see the pattern here with like all of the business, like Seas Candies and Coca-Cola and now Apple, where these businesses do not require a lot of capital
Right.
to grow. So Apple, most of their manufacturing is outsourced. Most of their money is spent into R&D and designing products, right, and engineering. So Apple generates massive amounts of free cash flow, which they actually use to buy back. So over the past 10 years, Apple has actually reduced its share count by over 40%.
Right.
And they keep announcing huge buybacks every year. So Warren Buffett's stake in the company keeps going up and up and up. So this is like a recurring pattern where he sees companies which are generating massive amounts of free cash flows, which can grow forever at maybe a 5% or a 7% CAGR forever, and they keep doing these buybacks, which keeps increasing his stake in the company.
Right. So that is also a very strong framework for the investor who have a large pool of basically sums, not for the basically the guys who have the limited resources. And with the limited resources, we actually can perform much better compared to the guys who have the large portfolios. If you can check the buybacks, then a lot of buybacks actually happens in the IT business, because IT is that kind of business which doesn't need lot of capital to grow. Because in IT businesses, major capital or major investment you have to do in terms of your employees as a salary. They don't need the large manufacturing units, they don't need the large buildings. Plus, right now after COVID, most of things are happening work from home.
Yes.
So that investment is also not needed. So these business actually are the very high quality businesses which throws lot of cash. And then if we can check, TCS has done the massive buyback a few months back. So this is the nature of those businesses. The very key understanding one should have in the IT businesses from the India is their base is very very small. The base of the Apple or the base of the US based tech companies or IT companies is very large. That's why their growth rate over the period of time reduces, which is probably not the case in India. Infosys or the TCS are also growing at a decent pace probably. And as a small investor, we also consider the growth as one of the key point while investing. Definitely, like quality of the business is important, quality of management is very important. And after that, like what kind of a growth I am getting out of this business, and then we'll come to the next point, which is margin of safety. At what price I am buying that great business? Because Warren Buffett says is like buying a great business and having a great investment can be two different things. Like if I'm today buying a Nestle at like probably 70p, and I know that Nestle is probably going to grow at probably 10% at the max, it is not going to give me the exponential returns. We as a small shareholders should actually think in terms of the exponential returns, because our portfolios are small and we have the enough opportunities. Only thing is like we have to put a little bit of hard work, we have to go through a lot of screening, which probably we do here at a Value Educator, and we have to come up with a small good ideas which can actually exponentially grow over the period of time, keeping all other parameters under check. So let's come back to the margin of safety, which basically Warren Buffett defines as like you have to have some cushion while you are buying a particular investment. You should not pay the full price, whatever might be the quality of business. So again, here we can link between the Nestle or Asian Paints or Pidilite or probably like HUL, where the business quality is very high, but the problem is with the valuation. So let's understand some of the case studies what Warren Buffett has basically invested over the period of time, and he invested in the best businesses or probably very good businesses at very good valuation, and that's how he has able to create a lot of wealth over the period of time. So Varun, can we have some case studies on the margin of safety, or what is your understanding about the margin of safety?
So, like how Warren Buffett defines margin of safety is like, suppose we have a bridge and the maximum load carrying capacity of that bridge is, let's say, 1000 kgs. If you're going to drive a car over that bridge and that car weighs about 990 kgs,
Right,
then you don't have a margin of safety. Your margin of safety is 10 kgs.
right,
And anything could happen. Like there is a risk of, the winds being high that day and the bridge could collapse. What you should be doing if you have a car of 990 kgs, you should go around and look for a bridge whose maximum load carrying capacity is 3000 kg. So you have a much higher margin of safety. So what this means is in investing is that if we estimate the intrinsic value of a business to be 1000 rupees, then we should not pay 900 rupees for that business, because our estimation, our assumptions of the intrinsic value could be wrong, and that could actually reduce our margin of safety, or we could even end up overpaying for that business. We need to buy businesses at much significant discount to what their intrinsic value can be. So maybe if we calculate the intrinsic value of a business at, let's say, 1000 rupees, we should try to buy that business at maybe 500 rupees or lower.
right.
Because we have a 50% margin of safety. Like even if our estimates are wrong and the actual value of the business is 800 rupees, we've still bought the business at a discount.
An important point we have to understand here is that Warren Buffett doesn't buy the cheap stocks. He buys those good businesses or high quality businesses at cheap rates. So here we don't have to compromise on the quality of a business. We have to actually monitor that business. We have to understand more and more about it. And just as I mentioned earlier, we have to be like a snake. We have to understand a good business and we have to wait, because patience is also very important. As we discussed earlier, that we don't have any strikes in the investment business or where we are actually managing own capital or some other capital. Here we can sit for a long period of time until unless we get our type of opportunity at our valuation. So let's understand about what are the historical case studies or how historically Warren Buffett has invested in different businesses at his valuation.
So the first example that we can look at over here is his investment in American Express. So American Express is a business that he bought at a significant discount. And this was back in 1964. where something called the salad oil scandal broke out. So American Express had this arm of their business where they were, certifying the inventory of, held in the warehouse for certain companies. And these companies would use these certification to actually take loans from the bank using the inventory as collateral.
Right.
So American Express had actually certified the inventory of one such company, which was in the soybean oil business. American Express had certified over $100 million of inventory for this company, which then the company took that certification to take like $100 million loan from the bank. What ended up happening was that actually the company was a fraud, and in their soybean tanks, they did not have soybean oil, but they ended up having seawater.
Yeah.
They had filled seawater into it, and this was a huge scandal which took American Express to the verge of bankruptcy.
Right.
A few days after this scandal broke out, actually, the US President John Kennedy was also murdered. Yeah. So there was a huge panic, and the stock market had crashed back in the day. So the stock price of American Express had fallen from over $60 to about $35 or so. And Warren Buffett at that time was already looking at the American Express business, and he liked their credit card business, he liked their traveler's check business. But what he was worried about is the reputation damage that this could cause to the American Express business. Because he also understood, same way like he understood for Apple or See's Candies, that this business reputation was everything, because American Express was a credit card that was used by the more affluent people in America. So American Express was able to charge merchants more for their credit card transactions because their customers were more affluent, and the merchants would end up getting more business from their customers. So this was American Express's moat. And Warren Buffett was worried that this moat had not been tarnished. So what he did was he ended up going out to different restaurants and different, hotels, and asking them whether, they still use the American Express credit card, or whether they still accept American Express traveler's check. And what he found was the reputation of the brand was completely untarnished. Where the, American Express had to, pay the banks back for, this loan. So American Express decided to, pay back the money that the banks had lost. So it was like a big one-time hit that took, that the P&L actually took, which actually looked as though the company was not doing well. But the long-term value of the company was, still intact. So Warren Buffett ended up buying this stock somewhere at around $41 in like June 1964. And then 2 years later, this stock was valued at over $92. So he's gotten over a 2x in 2 years in this business.
And another thing is, like, again, he has gone very heavy and allocated a major chunk in his portfolio. Probably he was holding about the 40% of the portfolio with the American Express when he was managing the funds for his clients with Buffett partners. And that is again a key understanding one should have, that like when you are right and when you have done the homework, firstly wait for the right company, then wait for the right valuations, and when everything is in your favor, you have to hit it very hard and you have to allocate a very good amount of capital. For it, we'll again discuss with the different case studies like how he has allocated a massive capital when the things were in his favor and how he actually got benefited out of it. So now let's discuss about what is the asset allocation framework Warren Buffett have in this video.
So Warren Buffett has bought over 100 stocks, 200 stocks in his career, right? So he's been investing for over 70 years. But if you look at his holdings today, more than 70% of Berkshire Hathaway's holdings are in 4 stocks, which is Apple, American Express, Coca-Cola, and Bank of America. Like we discussed before, within his circle of competence, where with a margin of safety, he has invested into these stocks. And what he has done is, whenever he got a good margin of safety, he ended up putting as much capital as he could into this, where like sometimes he's already taken like 40% positions in like some of these stocks. 40% of his portfolio was into one stock. So he always says that when you find a fat pitch, you have to swing hard. So when he finds these high quality businesses that fall within his circle of competence and he gets a good margin of safety, he allocates as much capital as he can to that business.
Right. And similar is the case with the Munger also. He has also allocated more than 50% of his net worth at any particular point of time to buy a single idea, and that needs a lot of guts because you need to have a very good amount of homework which you should be ready with, and then you have to wait for the right valuation. So let's discuss what he has done with the Coca-Cola and like how this allocation framework he played nicely over the period of time. And actually, due to allocation, he has created a massive wealth despite knowing like what to buy and when to buy. So let's start with the Coke.
So he initially first bought Coca-Cola in 1988, and back then he bought it after an event called the Black Monday, which happened in 1987, where the stock markets crashed more than 20 to 30% in various developed markets like US, Japan, Australia. So post that, he actually ended up buying 23 million shares of Coca-Cola, and in one shot, and that was 6.2% of the company, and it was his largest purchase to date back then. Then by 1994 he kept increasing his shareholding in this company whenever he was able to deploy more cash into Coca-Cola, and by 1994 he took his total shareholding to 100 million shares. And to this day he has not sold a single share of Coca-Cola. So he had 100 million shares in 1994, and twice the company has done a 2-for-1 stock split. So his shareholding has gone from 100 to 200 million and 200 million to 400 million.
Right.
And what happens was that Coca-Cola kept doing these buybacks, which kept taking his shareholding in the company up. And today he holds about 9.2% or about close to 10% of the entire Coca-Cola company. So his cost basis for Coca-Cola in his 2021 annual report is about 1.3 billion, and this is worth 23 billion in 2021. And in 2021 they also received about $672 million of dividends from Coca-Cola.
Right. So if you compare that, his initial purchasing price is basically he able to recover his own investment. And then we'll also discuss about what has happened with the Apple, how he ended up buying the Apple, the massive stake, which is like not a very old story, probably like about 5-6 years before. So Varun, like let's discuss about the Apple, like how he started and how his understanding about the business changed over the period of time, and let's relate that with the allocation strategy.
Right. So, like we said, right, he was reluctant to buy Apple in the beginning, and like two of his managers actually convinced him to put $1 billion which into Apple in 2016. So at that time they had acquired about 0.2% of the company for $1 billion. And as Warren Buffett studied Apple's business and he built his conviction, he ended up adding another $30 billion to that position, making it his largest position. So Apple is a company which is, Apple is the most traded share in the world, and it is a company which can grow at whatever 5 to 10% forever. So it is a business where he can deploy a lot of the cash that he has, where he's getting from all of these businesses like Coca-Cola, Seas Candies. Every year these businesses are giving him so much dividend,
Right.
and he needs to invest it somewhere. And Apple is a business which can take all of that, right? And same thing, the same story as we saw with Coca-Cola, as we saw with American Express. These companies are doing these buybacks which are taking his shareholding in Apple up. And even today you see like Warren Buffett is still looking to add more Apple, where there is, the shares have actually come down a lot and he's looking to buy
Right,
more
right.
of the company, right?
Right.
So he currently owns about 5.6% of the company. These numbers are from the 2021 annual report, and the cost basis in the 2021 annual report for his Apple shares is about $31 billion, and the value for that is about $161 billion. So Apple is one of those stocks where he actually invested a lot of capital. Like, it makes up about 30% of the cost of his entire portfolio and over 45% of the value of the entire portfolio of Berkshire Hathaway.
Right. So if you sum up the understanding about the Warren Buffett, so you start with the like good quality business, good quality management. Then basically you should do what you understand, which is nothing but the circle of competence. Then he comes to the valuation part. Basically, you should have some margin of safety on what your investment you are planning for. And the very, very important thing is like when you get the your type of opportunity at your cost, you have to really hit hard, like which is the allocation part. So we at a value educator also planning and trying to follow the Warren Buffett and his learnings, like buying a high quality business, looking for high quality management, and most importantly, it should come to my price. And there are actually a lot of opportunities which are available in micro and basically small size companies where we actually get this tremendous combo. And then whenever we have a very good understanding then we actually go and we allocate a good amount of capital of our total portfolio. So recently I have invested in one of the ideas basically where I was probably holding more than 50% of my total portfolio in one of the stock, and it actually have given about 3x returns in last about 3 to 4 months. So definitely it might be a coincidence, it might be a luck, but we have to keep our principles or our understanding right. In all cases, it might not be this type of outcome where like you can have a 3x returns in last 3-4 months. But if you have a right approach and if you have a right mental models, then definitely over the period of time we can create a massive amount of wealth. So that's why we have created this micro cap club where we are understanding different business models which are actually into small and micro size opportunities. Actually, a very good management we are looking for. Then the same about the business, and then if we get at very good valuations, then these ideas we are discussing in our club. And over the period of time, like we are able to find out the very good opportunities which have started giving us the very massive amount of returns over the period of time. So if you have not subscribed to Microcap Club, you can check the link in description, and on website also have in detail explain. And there is another video also which you also can watch on the YouTube about the Microcap Club, how this actually works. And in this we will able to find out a lot of ideas where we actually can like do a lot of scuttlebutt, and I will be sharing those ideas with you. I will be sharing my scuttlebutt understanding with you, and like the valuation guidelines are also we are giving to our subscribers. So make sure that you subscribe to this microcap club. Here we are offering the extra months also on the various like yearly services, 1 year, 2 year, various things are there. So you can check the more details on the website. And please let us know like what is your understanding from the Warren Buffett's career. What are the different guidelines you follow which you learned probably from him. After watching this video, if you are able to understand more about the Warren Buffett criteria to identify different businesses, make sure you like this video and subscribe to the Value Educator channel. We are continuously working very hard to come up with the different content which will actually help you to understand about the different business models, be it the Loras Lab, be it the Divi's Lab. We are also going to come up with the Piramal as our next video, where we are going to discuss with again Varun, and what are the valuations of the Piramal Pharma, what are the risk and what can be the advantages. So that we'll be discussing in next videos. So if you are liking these discussion sessions with Varun, make sure that you like this video and like subscribe to the Value Educator channel. And don't miss these videos at 11 o'clock every Saturday. We'll discuss about some different company or we'll discuss about some different mental model next Saturday at 11 o'clock.